What trend are you riding? The question we ask ourselves every Thursday. We welcome you to the webcast on Trading the Trend. The trend sometimes is not up, sometimes it's sideways, and sometimes it's down. Today we'll talk about just a few stocks that actually might be headed down. And we'll talk about kind of some strategies with that as well. So, with that said, we'll go ahead and hop right in. How are you doing here today? We got Texan with us, Zach with us, Greg with us, Will, Kevin, Jill. Jill, how are you doing today? And we also got with us Scott Thompson in the chat. Now, as we get started, if you have questions, go ahead and ask them. Sometimes when someone is presenting, it's hard for them to answer questions as you go. Look, just go ahead and ask. We'll answer those questions along the way here. And got Lisa with us here as well, the biggest White Sox fan of all time. Lisa, it's still funny to me. All right. Anyway, she's a Chicago Cubs fan, but I always tell her she's a White Sox fan. Now, with that said, let's go ahead and get started. Now, remember with what we discussed here today, options carry high level risk, not suitable for investors. Our examples will be stocks and options. Remember when we talk about examples, we will do those in the PayPlenty software application. Investing involves risk. Without risk, there's no reward. Okay. And so we need to understand that. How much risk are you willing to take to see if that trend could materialize? It's really what you do, okay, as investors. Now, as we also get started, we'll talk about some of the trends. We'll look at just very quickly markets. I will look back at gold and silver. I want to see if we can't do an example there, bearish. And then we're going to also talk about some sectors and some stocks. Now, next week, I will be out in Oklahoma, out in the oil fields slash feedlots of America. I will not be teaching next week. So with that in mind and why I say this, the examples we talked about today, you got to think that there's some type of trend. I'm not going to do examples just because we have a class today. We need to actually be thinking that maybe why we're gone and I'm gone, doing other things. Could these trends continue? Now, that's very important because sometimes you're like, is it just for today? No, the idea is getting the trend. So when we talk about trends, short-term trends, 2-3 days to 2-3 weeks. When we talk about intermediate trends, 2-3 weeks to 2-3 months, long-term trends, think about quarters to years, okay? So our sweet spot that we're really looking for is really 2-3 days to 2-3 weeks, shorter term, but then getting into that intermediate 2-3 weeks to 2-3 months. The purpose of why that last one is very, very important is because every time you put on a trade, you take risk. So the goal is to try to see how many fewer trades you could do to try to risk less and try to get the trend to trend. That's a very big point. A lot of times when people get started in the stock market, they're just doing lots of trades, but with every trade you take, there's risk. And you add that up cumulatively over the year, it's substantial. That's not our goal. The goal is to try to get some stocks that could be running to the upside, okay, and trying to let those move, okay? Now, with that said, let's go ahead and kick it off. Now, just really quick, SPX, fast. When we look at the SPX, neutral. Now, I'm not going to get into the strategy here, but I'm not saying that the S&P has blown the doors off in the last, let's say, 2 weeks. You got to remember, we are in the summer months, okay? Sometimes in the summer months, you can get consolidation. I remember back in 2005 where the market for 6 weeks barely moved. So much so I kept looking at my internet connection to see if it was still good. The SPX, I think if we looked for the positive, we cannot believe how well the S&P has been able to hold, considering that the NASDAQ has not done great in the last little bit. Now, again, we got to put that in context. There was a 30% run in the NASDAQ in less than 2 months. Could you imagine if someone had tech exposure from late March all the way to, let's say 2 months or so? Excuse me, I misspoke. I said 30. It was 34%, but who was counting? And the index, not the stock, the index moved 34%. So this is kind of consolidating this monster of a run. is it index supposed to go up 30%, 34% in 2 months? Okay, maybe not, but it did. So that's kind of cooling off. Let's just say that. Stocks, you're going to see that that is, well, hit a fresh low here today. We'll circle back to that in just a moment. But we said this morning, the stocks, the gold, down 57 to 1.4%, silver. This really hurts. Now, remember when I told you that my wife said, "Hey, honey, I'd like to maybe get a piece of jewelry or whatever." And I said, "Honey, we don't buy depreciating assets." I showed her the chart. And I said, "This is why I'm not going to buy you that." And I stand by that decision. Okay, that would have been a mistake to buy that piece of gold for. Gold prices would went down. Of course, I bought a present anyway. It just wasn't gold. Okay. So, but overall, those jewelry pieces may be getting a little bit less. Diamond prices, by the way, they're not that great either. Okay. So, precious metals being just soft. If we look at, let's say, copper is actually held to some extent, but that's the major of the three that we could actually see that actually have held decent. Dow Jones, we're trying to move to the upside, trying to. Okay, you actually did go up to get above the 20-period moving average. Not the biggest bounce that we've actually seen in our life, but trying to get a bounce. Now, when you actually take a look at, let's say, the smaller caps, not so much. Okay, I mean, it's still large caps, and this is where it goes back to the mega caps. Okay, the Magnificent Seven. Those have been the ones that have really gotten the moves. Now, super quick, when we look at the technology sector, here's the technology sector. Now, again, I don't like this index, okay? I have to show an index because it's not an ETF class. Let's look at the technology sector tomorrow on the ETF that we normally quote. But if we looked at the technology index, that doesn't look great. Okay. Now, when you look at the transportations, I need you, well, go look at some of the rails. It's not just CSX, UNP, it's NSC, among others, that have actually gotten a pretty big push. The rails, and they're not just shipping empty rails here, okay, rail cars. There's something in there, okay? Some pretty good moves in the rail space. Now, the financials, okay, still up. The one that we want to kind of take a peek on today is real estate. Again, the money flows somewhere. If that technology money is going down, where are they putting the money? Now, here's what's nice. When it's a billion, 10 billion, 50 billion, 100 billion, $1 trillion, man, it's going to be hard to bury that money without seeing a little bulge underneath the carpet here. So keep an eye on what sectors are actually hitting some new highs or showing some bullish behavior. Now, transportation is, real estate is, could that be a shift? That's the point, right? Now, if you also look at the communication, something we're going to keep an eye on, and also the IXV. Okay, now, of those four, well, the couple that we mentioned, energy, financials, real estate, communications, transports, healthcare, which one kind of stands out a little bit? I don't know. I mean, it kind of seems like maybe real estate, if we're saying right now. Okay, now, any questions with this? Okay, now Lisa actually says UPS with a nice reversal. Big Brown. Okay, now here's the case. Okay, so let's kind of look at some of these transports for just a moment. Okay, now let me kind of get us a feel of what is in this portfolio. Where might there be some neglect? We always say that in the portfolios, we like 3 to 5 sectors. Okay, 3 to 5 sectors. So now some of those, we might be top heavy growth. If there's growth is moving, growth is not just tech. We said it's energy, it's materials, it's discretionary. Mid betas or mid growth, we would probably say industrials and financials. When I say industrials, we're saying transports. If we say lower growth, we're saying utilities, staples, healthcare, and real estate. Okay, now what is in the portfolio? Well, we got tech, financials, industrials, staples, transportation, healthcare. So we got a pretty good mix. Now, these are all just shares. There's also on Apple right there, there's technology. AXP was also a vertical, so you got financials again. There's a bearish trade on tech. And there's also a bullish trade on Dell, which we're down, and there's Marvel. So you're going to see that Marvel's bullish, Cisco's bearish, and that Dell's bullish as well. So both Dell and Marvel down. We'll talk about that in just a sec. You got Morgan Stanley, financials, and you even got discretionary. Okay? So we're not just saying one thing out one side of our mouth and then doing something completely different. We are kind of spread out. Now, if we said, well, do we have any real estate? The only real estate that we actually have is in the IRA, and that's in Wells Tower, the REIT itself. All right. Now, by the way, nice day for that's an area that I want to kind of talk about here today. I mean, if you can't tell. So let's look at now. By the way, if we said rails, do we have rails? We've had rails. Okay. The CSX is sitting right there. Could we look to add one? We got money left? Yeah, got a little change left there, 77 grand in the IRA. Margin account, 10 grand, not that much, okay? Might have to maybe look and see if one is done and try to reload there. So let's kind of start with just real quick this UNP, since Lisa made mention of it. No, UPS, excuse me, UPS. Now, if we look at UPS, you're going to see that on this chart, you're going to notice that right there, 728. We've always said, that when you're 2 to 3 weeks prior to the earnings, this is when you tend to get speculation. People are putting on trades in what they think could do well on earnings. This is just like the farmer who plants a crop thinking that that crop could do well. They have to make an investment before they get a harvest. And once they actually get the product to be what it needs to be to reap the benefits, then they cut it down. Okay? It's just like that with these earnings. So investors are investing before they know the actual returns. They're speculating, hoping, wishing, whatever you want to call it, forecasting, okay, of what the earnings could be. That's why many times on earnings we actually see the price actually go down. Why? Because people are reaping the rewards of what they expected. Now, we take a look at this. Is there now we could say, well, yeah, 120 is the prior high. It's not going to go high. We don't know that. Okay. The fact that this is actually going up probably tells us the economy is probably stronger than we think it is. Okay. FedEx, if we pull up big FedEx, that's kind of at that little bounce area. A little bounce, a little diagonal reversal, but not as strong as, let's say, UPS. Now, UPS, if we pull this up here today, we've talked about this a couple times, the little green dots on the chart. That's just showing some higher lows along the way. Also what we call bounce entry setups. What I'm going to do, if you don't mind, is I'm just going to set up, if we can try to, now, today's class is going to be a little faster. Okay, so just buckle down. So if someone's just talking to you, someone's texting you, just say, not right now, okay? What we're going to do is we're going to right-click on this chart, buy custom, and I'm going to say with stop. Okay. Now, what I'm going to do with this is I'm going to go back to this diagonal trend line. And if you don't mind, I'm going to kind of connect these little dots. And that's what's nice. Horizontal, diagonal, kind of see like a trend line. Okay. Maybe right about right there. Where is that line? It's going to be right about 111.83. Okay. Now, on the paper money account, we're going to go back in. Looks like we have a little bit more capital we could put to work. And I'm going to go right-click, buy custom, with stop. Now, we said before 111.83. Okay? So 111.83 was the diagonal support, less 2%. It's going to give us 109.59. So if someone's buying UPS, what are they really saying? Look, I want exposure to the transportation sector. Okay? 109.59. Now, a lot of times people will say, yeah, but the tech is going down. Yeah, but the semis are going down. And our point to that is, yeah, let's kind of see how the other parts of the market are reacting, like other sectors. Is tech dragging down financials? Doesn't look like it. Is tech dragging down real estate? Doesn't look like it. Tech dragging down healthcare? So sometimes you can actually get technology softness But the other areas are benefiting from people selling the tech and moving to other areas. Now, if we look at this, in this example, this is a stock position. Let's show the example, and I'm just going to use a number of $5,000. Okay. So if we did $5,000, it's going to be 42 shares of stock. You got a stop loss. What we're now going to go ahead and do is say confirm and send. Don't look at target. You're getting ahead of me. Okay. Super target. Now, if we take a look at this, limit, stop, confirm, send. Now is this an option position or a stock position? Well, there's no expiration. There's no strike. So it's a stock position. Okay. Now, UPS 107, 117.04 or less. Stop if it goes to that price or less. Trade number one, UPS. Now, all right. So now why didn't you do like more capital? Well, I'm going to kind of put an alert right at the middle of the candle and say if we go at or not above, below, let us know. Because if we go at or below the midsection of that candle, that could be your classic, like maybe higher low potential bounce. And there's a little capital left that we could try to add a little bit closer to support. Now, let's fast forward. So just real quick on CSX. Let's go back to what is CSX? Well, CSX is shares. Those shares were purchased at 40. They're at 50,000 bucks. They were purchased on 330. Okay, so it's about 3 months there. The put position, okay, now remember, if the stock actually goes up, well, the put price tends to go down, time decay. Now, what's happening is, now the good thing is, the strike that we have is still 47.5, okay? So meaning it's not that much lower than where the current price of the stock is right now. Now, here's the thing. You got two things in your hand. Stock, long put, protection. Now, what's interesting is when you talk to an investor, setting a stop, position sizing, buying a put, etc., these are ways the investor is trying to have risk management. Now, if you said to an investor, the investor said back to you, I don't do risk management, I just invest money and I don't care about risk management. Maybe they don't understand the question, okay? Investors that understand what they're doing, and there could be some that don't, typically want a risk management, okay? Position sizing, setting stops, buying a put. Fair? Buying a put is a right to contractually sell at the strike price. Some people like to buy puts if the implied volatility is lower, okay? And what that's going to do is make it where the stock doesn't have to go up as much to break even. And it contractually gives the right to sell those shares at the strike from now to expiration. Okay? Not a maybe, perhaps, depends, and so on, like a stop, a right to sell at the strike. Now, we wouldn't want to exercise the right to sell the shares at the strike now, well, because the stock is higher than that. If we exercise that put, it's going to sell the shares at 47.5. We had 100 shares. We sell 100 shares. We don't have any position anymore. Okay? So we're hoping that never becomes worth something, because if it becomes worth something, it says that the stock position we have goes down. Does that make sense? So when you think about put protection, that is exactly what it is. Protection. If the protection becomes worth something, it means that the main point of why you got in the position to begin with didn't work out. And it's trying to minimize the risk. All right, now let's actually go back to just real quick. Are there any others in this area that we could look at? Let's go back to UMP just real quick. So UMP, again, a lot of people say, well, yeah, with the stuff going in Iran. Remember, like I said this morning, there's going to be stuff all the time. At one point, it was Greece. Greece needed to borrow money, else the island was going to literally detach from that region of the world. Greece survived. The ECB survived. The United Arab Emirates were going to go bankrupt. They didn't go bankrupt. Okay, so the moral of the story is there's always stuff. Okay, You got to get used to that there's going to be just news constantly. And when you run a business or whatever it is, etc., there's always going to be stuff happening. Welcome to the real world. That's the problem with being an employee. Sometimes is you're so used to being in a little limited mindset of I do this job. But when you talk about investing, we need to widen those walls out. The real world. Okay. Now, I'm not going to look at UMP because it's kind of had like a little breakout, a little continuation. And if you look at this right here, gosh, dadgum, I thought it was going to be a little bit closer. NSC, that's also had a pretty good move there. Now, are there any other rails that we're missing? Speak now or forever hold your peace. Scott, also, if you know one, let me know. UMP, we talked about it. CSX, NSC, I don't see one. Okay. We said this morning, Old Dominion Freight, JB Hunt. That's actually a bald spot that's in the portfolio. We don't have a truck. Okay. JB Hunt. Okay. So let's hold that thought for just a second. AODFL. Okay. Little bounce there. So which one's passed the earnings? It's the JB Hunt. Okay. Now, July 29th is Old Dominion Freight. What's interesting about this is it has a little move. You got a prior high at, let's say, 248. How about we just do both examples? Let's fast fire these, okay? Now, if we went back to this, I'm going to right click on this chart, okay? And what I'm going to do is I'm going to right click, buy custom with OCO bracket. Now, what I'm going to do, just because, well, sometimes you like to do it like this, we just need to make sure the capital's right, okay? So if we were going to use $5,000, now I want to kind of speak to this for just a second, okay? The longer that you invest, you're probably going to start to realize it's not about one position. If you set a stop, if you put protection on, if you position size, you're going to have gains and losses. The only thing that the investor really cares about is not what the win percentage was in the portfolio on historical average, but it just really does the account balance go up over time. That's the real scoreboard. How many wins, how many losses could have helped the balance? Sure. Okay. But the moral of the story is in that balance, there's going to be wins and losses. So whether Old Dominion wins or JB Hunt wins, I don't have a clue. What we're trying to do is use the capital to see which one could move. Now, if Old Dominion doesn't work, JB Hunt or another stock in the portfolio needs to move up to offset. Riding the trend cannot be done if we're impatient. Now, James, have you always been patient? Absolutely not. Number one, what causes the lack of patience? Number one is you don't really understand how the trend works. Number two is you're just kind of always looking to see what's moving the most for the day or two. Trend is like a relationship, whether you're going out with someone or a marriage. The moral of the story is it's not just day over day. You're trying to ride multiple weeks, multiple months. And so in that period of time, there's going to be some pullbacks. The pullbacks, though, could be valuable because those pullbacks make potential new support levels that are higher potentially, or hold, and second, and or higher lows. Okay? Now, what I'm going to do in this example, I'm not saying this is all, but I'm going to put a target right around 250. The stop underneath, I'm going to put it right underneath yesterday's low, 222 and change. And if we take a look at this, that's going to give us a stop at 219.52. So I'm taking that point on the chart, 224, less 2%, 219.52. And if I type that in, 219.52, there it is. Now, this is why not putting all of the eggs in one basket is important. $5,000, okay, on a portfolio that let's say is at 170,000. This position really represents 3% of the capital. That's a little lower than what we normally talk about. We could easily push this to 7,500, and we still would not be at 5% of the portfolio. So what is that really allowing us to do? If we just did stock trading by itself, we could have probably 20, 25 positions spread out over stocks and the products we talk about tomorrow and try to have those averages go up over time. Okay. Some win, some lose. Okay. But the end of the day is we just really want that balance over time to grind higher. Okay. Now, what also starts to happen is you kind of get numb to like ones that win and lose. Again, because you're just looking at the scoreboard, the balance. Now, remember is if you take a look at this, that stop loss is saying if we go to that price or less, sell the shares. Okay. Now, if we at that price or less, go back to JB Hunt just real quick, fast fire this one. Okay. JB Hunt. Now, this already had the earnings. That earnings was $1.91. Now, do you notice how many earnings so far where the actual numbers on many of these have actually done quite well? United Healthcare, Wells Fargo, and so, JB Hunt. This is another one where they're 20 cents off, okay? Now, if you take a look at this, same thing that we talked about with UNH when you have the earnings date. Some people like to wait 2-3 days after the earnings and then try to get the bounce. I'm going to do the same thing, just maybe take a slightly lower position. I'm going to do the 5,000, which is only 3% of the portfolio value. 3% is going to give us about 16 shares. We're going to give it a little bit more breathing room on this. That bottom end of where we kind of had that little shorter term double bottom, 276.24, less 2%, 270.71. Okay, I'm going to put that right there. Now, I'm going to hold for just a second. So, number one, JB Hunt shares. Number two, Old Dominion, okay, shares. What was another trade that we actually did? What was the other one? You want to make sure you're following along. Now, remember how that stop works. If it goes to that price or less, sell the shares. So we got 2 trucks. And then also go back to transportation. There's the third one in transportation. UPS, okay? And now if we go back, any others. So it looks like 3 transportations, okay? Yep, 3 transportations so far. Now, let's go back to this because we need to. Now, man, that Target, this is where the investor says, I like green days and I cannot lie, okay? Trend 3, prices above both moving averages, 296. Decent little push here in the portfolio. 455 for it. Half of the gain came off today. Okay. Now remember, we could have woke up and said, oh, Iran said this, Iran said that. Look, Target didn't care. Okay. And this is what you got to do. You got to almost invest, focus on how you invest. Focus on your strategy. There's always going to be stuff on the exterior. Always. Okay. Now, if you take a look at this, I want to go back to this one, Target. I want to go back to Well for just a sec. Just want to see what that looks like. Target, there's nothing we can really do on this because number one is it already has enough shares. Number two, could an investor say, I want to maybe sell a call up near this prior high? Could they? If they sell a call up this prior high, they're really thinking maybe it does a little double top, maybe it consolidates for a little bit, et cetera, et cetera. But the moral of the story is the trend they're thinking is up. But could they just in the short term say, look, I want to counter it just a little bit to see if it does consolidate or pull back? Sure. There's 153 shares here. If we said, well, what type of premium does that actually have? Let's take a look. Well, first thing, just to kind of get an idea, 44% on the implied volatility. Smell that? Might be opportunity. Well, let's go take a peek. Can't just jump to conclusions. If we go look at, let's say, the strike on the call side, delta 30 to 40, we got 360 bid, $4 ask. If we took 380 and we just look at this on the current price, that's 2.7% at the current price, not what we own it at. Obviously, That would even be a higher percent because we got the shares lower. Now, what I'm going to show example given is selling the call in the short term, meaning we're staying long the shares, but saying, could the stock pull back a little bit? 153 shares going to sell a call, a strike, the 150, trying to get the 380. Now, some people, they're saying, look, I want to be long the shares. If it does pay a dividend, which we know is not guaranteed in time, they could cut it, suspend it completely. They could raise the dividend. The answer is we don't know the future. And if you take a look at this, it's a quarterly frequency. The ex-dividend date is coming up. So we got $1.16 coming up on the dividend per share. We're going to sell the call, trying to get the stock appreciation, trying to get the dividend, but maybe being a little greedy. Trying to sell a call and get some of that premium as well. Now, if we pull back a little bit, the investor might try to trade that premium. The price drops, maybe that drops down to $2.80. Maybe it drops down to $2. Maybe it drops down to $1.50, whatever. They're just trying to trade that premium. They're trying to trade the price fluctuation on the stock that's affecting the option, and then theoretically lowering the average price of the stock and trying to stuff a little lunch money, premium, into the portfolio and push up that balance as that stock is pulling back. Am I speaking English here? Does anyone know what I'm talking about? Or am I just like the only one that might try to call a short-term top and maybe get a little pullback and try to trade a little bit of the option premium / stock price movement? We on the same page here? I just feel like I'm alone right now. Make me feel like I'm not alone, okay? Now, I'm going to go in this case. Now, by the way, the mid-price change, we're going to push 390. Doesn't mean it's going to fill. We'll have to verify. And there it is right there. Now, we got to make sure. Yeah, so there is. Okay, so that should work. Send that. Notice the commission. Send. Okay. So it's 153 shares. We're selling 100 of those. If we were called out at 150. Now, here's the deal. If someone took those shares from us at 150, the stock right now is at 141. Could that happen? Could. Unlikely, though, because the stock's not even at 150. Okay. Dean, thank you so much. Jax is with you. You're not alone. All right. Okay, good. Now, okay, good. Let's take a look now. Okay, I just want to see okay, good. Now, what I want to do is let's also go back to the one that we need to make mention of, okay, is I got to see which account it's in. Let's close that. Let's take a look. Oh, yeah, by the way. So I open these up because these are ones we need to bring up. The Amazon example, okay? I kind of joked with you a little bit when the Amazon person came to my house and said, hey, you've ordered 57 packages this month. Congratulations. I told him, don't ever congratulate that for me again. Now, that doesn't mean everyone should buy it at Amazon. It's my son's wedding stuff, okay? So it sounds worse than it normally is, thank heavens. But anyway, so if we take a look at this, and we all buy some stuff, okay? Amazon, long call, sold the 255 call, long call vertical. Now, here's the thing. This is where the investor looks at this and says, man, if I could have just bought the shares on June 16th, a month ago, if the investor would have just bought the shares, they could have been up more. Maybe. You have to go back and see where it was on June 16th. We'll go back and see where this was on June 16th. Pull this back up. Where was it on June 16th? Maybe not. June 16th was right there. Now, if you bought the shares on that day, that gain or loss probably would have been over double. Yeah, it would have been over double if you just bought shares of stock. If you bought 100 shares of stock, okay? It depends on how many shares you had. Now, we didn't buy shares of stock. Now, one of the reasons why we do verticals a lot is sometimes with these verticals, you can take more up movement and down movement, and it's not moving the profit loss as much. That's the point. Okay? It's not just the defined risk. It's when it goes up and down that we can handle more movement. Okay? We get that? Now, what did it do? We were very good about picking the short-term top, and then what did it do? It went down. And if we look at this and said, man, it went down $20, how much was that? Well, for every, number of contracts we did, the delta probably would be 10. So if we actually did a contract, and if the delta was 10 for the vertical, the position at one point might have been down $200 if the delta was 10. Now, as we flip it and go to the other side, now it's actually up about 860. And if we actually did, let's say, one contract, we're thinking it's probably at least 10 delta times 8. It's at least up $80. Now, that's not the only way. There's other factors that could benefit. But if you take a look at this, how much is it up? The answer is it's up 362. Which side of the trade is up? Well, if you take a look at this, we got a 345 call. The call has not benefited. It's holding intrinsic value, but the side of the trade, this is not a shocker, okay? The side of the trade that has benefited is the short call, the one that has the time, fill in the blank, decay, okay? Sold it for 640 and now it's at 259. So this goes back to kind of what we normally look at. The only constant is time. Direction? It's not constant. It's not. We don't know if it's going to go up. Don't know if it's going to go down. Don't know. Volatility could go up or down. Have no clue. Could go sideways. But the time going to expiration. This is why some people like maybe dividends and or let's say selling options per se. Not all. Okay. Where they're trying to get time. This is what's kind of interesting thing about, let's say, investing is some people go for direction. Some people are going for time. Think dividends, ops, and premiums. And other people are going for volatility. Some strategies are trying to do all of those. Some only focus on one of those. Now, what we're going to do is on this one, Amazon, right-click on that, create closing order, sell. Now, if we take a look at that, we're going to go ahead and exit that position, $353. And you're going to also see that we have shares, but just act like you didn't see that. And we're going to go ahead and confirm and send. Now, how come we're not waiting? Okay. The reason why we're not waiting more is we're out of time. Now, if you look at Amazon, it has earnings on July 30th. The target on those 20 shares is right at 257.59. So with that in mind, we're going to see that today's high was what? Today's high was 258.08. What are we going to do? Tell me what we're going to do. Now wait, hold on. Where's the target again? 259.57. Where was today's high? 258.08. So that means we were trying to really make 259.57 less 258.08. We were short of that target. $1.49. Now, where's the stop? You can see something's wrong on this position. You should be screaming it right now. James, move the stop up. Now, two options, right? We're going to take it from the highest price, 258.08, less. That's where the highest price was. We do not care if you were at the grocery store, the post office, or taking the puppy or the cat to the vet. We don't, the investor doesn't care. So now what it's doing is actually saying, look, the stop is going to be moved up to 256.59. And if we did that 1-to-1 reward risk ratio, you would be stopped. You'd be triggered to be stopped out. Got to see if you can get a fill. If we did, let's say 1.5, you'd probably even be pretty close to being stopped out. Now, what I'm going to do is I'll take that 149 times 1.5, 2.23. Okay? So 2.23, that's the reward remaining, okay, that we didn't get. I'm timesing it by 1.5, it's 2.23. I'm now going to take it from the highest price, 258, 255.85. It doesn't matter if we use 1-to-1, 1-to-1.5. This is actually telling us that this position, if I move the stop up, it should be triggered out. Okay, now, but wait, hold on. Wonder if you said you wanted to move up your target. Okay, so now it's different. If we wanted to move up that target and say, look, I think we can I want to move it up a little bit more. Now, how many of you have ever had second thoughts about targets and you said, hey, maybe we're going to get a little bit more of a bullish move? Well, if you want a little bit more of a bullish move, you might move up that target on that stock position and move up that stop maybe a little bit underneath the moving average and so on. I'm going to do that because I got this feeling that someone might be thinking about raising the target. Anyone out there thinking about raising the target? Okay. So on that one, we're going to kind of show the example of raising the target on that and seeing if we can't get the move. Now, it would be helpful if the market was bullish. Second, it'd be helpful potentially if the sector was bullish, okay? If we take a look at that sector, IXY, I mean, again, go look at the product that tracks the sector. This is an index. Are we really getting a move in the discretionary space? You know, some of the move, I mean, this goes back to the rails and the trucks. I mean, what's on those rails? What's in the trucks? What's being shipped on the water boats and so on and so on? Okay, now something they're not empty. So this kind of goes back to it's like there's some production and distribution to endpoints to sell to consumers of something. That usually goes back to these discretionary sectors. Now, I would feel horrible if, for crying out loud, thought it was at $3 up. It's $5, okay? But sometimes this goes back to some of these companies, Super Target, Amazon, Apple. These are just you could say they're kind of like retail shopping centers. Amazon kind of really does one of everything to some degree. I mean, to some degree. But Apple, you could say it's discretionary. Some people it's not discretionary. It's a staple. They need it. It's their telephone. It's like communication. And also it's maybe like a discretionary item, so on and so on. Now, I want to just double check this position. What is on that is in the IRA. What do we have? Okay. Now, right here, so we have the 290 put, the 280. That's going to expire. And the other one we have that we rolled is the 285 and the 275. So 2 put verticals. Now, this is why people trade stocks. While this was, great, but the investor might have said, geez, maybe the investor should have just bought the shares and had the dollar for dollar movement with no expiration, where it's just focused on being right the direction. Now, sometimes that doesn't turn out. But if it does, oh my gosh, it could be interesting. So on this margin account too, you really got more of a cash secured put. That's a wider strike, okay? Now, I think probably if we kind of said, what's one of the ones that's been the dog of the week, it's really been Dell that really tricked investors thinking it was going to go bullish, and someone came out of the woodwork and pressed down the Dell position quite aggressively. Haven't seen a whole lot of news on that. Hasn't broke support, but boy, did it go from top to bottom, okay, in the channel. Now, I'm out of my time here. I'll teach back tomorrow morning on ETFs. Do not be late. Got a lot to talk about on ETFs, especially right around earnings of individual companies. I want to say thanks to you. Thanks to Scott Thompson as well. I think we had a fun session here today. Okay. And also remember that we got short verticals coming up next with Brett Crowther. And also what we try to do is kind of focus on some of those areas of the portfolio that maybe there wasn't really a lot of focus, and we tried to add to that area in terms of, let's say, transports and discretionary focus as well. Remember that all investing involves risk. Also, do not forget to subscribe to the Trader Talk channel. It's free, okay? And you could actually subscribe to that right on YouTube. With that said, thanks so much for your comments and your participation. And stay tuned for Brett Crowther coming up next. Take care. Bye-bye.